Have you looked at the economic headlines lately? It feels like they're completely broken, right? They're telling two wildly different stories at the exact same time. And today, we're going to make sense of all that confusion. I mean, think about it. On one hand, you're hearing about massive job cuts, the kind we haven't seen in years. But on the other hand, the stock market is hitting one all-time high after another. How can both of those things be true at the same time? That is the big mystery we are going to solve right now. And this really shows you the divide perfectly. You've got the reality on Main Street for so many people. That's job cuts, recession fears, just general financial stress. But then you look at the headlines from Wall Street, and it's all S&P 500 highs and strong GDP growth. It's literally a tale of two different economic worlds. So let's start with Main Street, because this is the side of the economy that millions of people are living and breathing every single day. And the data here, well, it tells a very clear story of struggle and a whole lot of uncertainty. First, let's just look at the hard numbers. So far in 2025, U.S. employers have announced nearly 1.2 million job cuts. Now, this isn't just some small uptick. This is a massive wave of layoffs that's hitting industries all across the board, from tech to manufacturing. And to put that number in perspective, this is the most challenging job market we have seen in 16 years. You literally have to go all the way back to the great financial crisis in 2008 to find a time with this much job insecurity. It's a really big deal. And here's what's really interesting. It's who is being affected. The pain isn't just stuck in one industry. As you can see here, Americans with four-year college degrees now make up a record 25.3% of the unemployed. That is double the level from 2008, which is a clear sign that even highly educated white-collar workers are really feeling the squeeze. So it's really no surprise that all this data translates directly into how people are feeling. More than 60% of Americans genuinely believe the country is already in a recession. For them, the high cost of living and the constant financial stress makes it feel that way no matter what any official report might say. Okay, so now let's pivot and look at the other side of this puzzle. Because while Main Street is feeling all this pain, Wall Street is basically throwing a party. The financial markets are not just healthy, they are booming at a historic pace. This table just lays out the disconnect perfectly. While over 60% of people feel like we're in a recession, the official gross domestic product, or GDP, which is the main measure of the country's economic output, it grew by 1.6% in the first half of the year. And meanwhile, the S&P 500 is just hitting record high after record high. The numbers just do not match the feeling on the ground. And the scale of this boom is just staggering. Since April alone, the S&P 500 has added a whopping $17 trillion in market value. That is an immense amount of wealth being generated in a really short period of time. So the crucial point here is that this isn't a fluke. The market is on pace to set its 29th record high this year alone. It is one of the most powerful and sustained rallies we've seen in decades. So this brings us right back to our central question. How is this even possible? Okay, so we've seen the two conflicting stories. Now, let's finally unlock the answer. The key to understanding this bizarre economic moment we're in lies in realizing that we're not living in one single economy anymore. The answer is this simple, but it's also incredibly profound. We have two economies operating in parallel, but heading in completely opposite directions. So let's define them. First, you've got the AI-driven corporate boom. This thing is red hot, fueled by trillions of dollars pouring into artificial intelligence, data centers, and big tech. Then there's the consumer economy, the world of everyday spending, which is weakening under all the pressure from inflation and job cuts. Now this slide, this is the smoking gun. This is the proof. Business spending on AI-related infrastructure, like data centers, has tripled since 2022. But at the exact same time, all other business spending has actually fallen by 20%. See, one part of the economy is just exploding while the other is contracting. And look at this incredible statistic. A massive 63% of all U.S. economic growth this year can be traced back to that AI spending boom. This one single sector is so powerful that it's propping up the entire GDP number, and it's masking the weakness that's happening everywhere else. So, we've explained the what. Now let's explore the so what. What does a two-track economy actually mean for people's lives and their financial futures? Well, the consequences, as we're about to see, are pretty significant. A huge part of this story is market concentration. The top 10% of stocks in the S&P 500, and yeah, we're mostly talking about those giant AI and tech companies, they now make up an incredible 76% of the entire market's value. This means just a handful of mega companies are dragging the whole index upward, even if hundreds of other companies are flat or even falling. This market concentration brings us to a really fundamental truth of this new economy, and it's captured perfectly by the quote on this slide. In today's economy, savers lose purchasing power to inflation, but the owners of assets, like those top tech stocks we were just talking about, they're protected. It is a stark, stark divide. So, given this new reality of a two-track economy, how should we be thinking about protecting our financial well-being? This brings us to the new rules of building and preserving wealth. It really all comes down to this one core concept: purchasing power. It's not just about the number of dollars you have, it's about what those dollars can actually buy. And when inflation is persistent, the purchasing power of cash steadily melts away, kind of like an ice cube on a hot day. So how do you protect that melting ice cube? The crucial hedge is owning assets. This means things that are either productive, like stocks in a company or a piece of real estate, or things that are inherently scarce, like commodities, gold, or even Bitcoin. Unlike cash, these things tend to hold their value, or even increase it, when inflation is high. And that leaves us with a final, pretty provocative thought. In this new two-track economy, where the gap between asset owners and everyone else is getting wider and wider, is owning assets no longer just a strategy to get rich, but a necessary step simply to avoid getting left behind? Definitely something to think about.